The live intraday market movement for NVIDIA stock shows the price trading at exactly $214.97 per share, representing a steady upward push of 1.11% during today's session. While the broader public assumes this slight bounce is just standard market noise, a deeper look reveals something far more interesting underneath the surface. The options market just went through a massive implied volatility crush, which completely neutralized a standard directional breakout that typically follows an earnings beat of this size. This massive discrepancy between extreme derivative positioning and stagnant underlying stock equity is the true mechanical force keeping the price contained right now. Most market participants look at this chip giant and simply see a company riding the wave of high-performance computing, assuming the equity should climb in a straight line forever as long as the data center demand remains high. The general belief across social media and mainstream financial networks is that institutional buyers are just waiting to accumulate more shares at any price. However, the contrarian truth is that the biggest asset managers are executing highly surgical, multi-month distribution patterns. They are intentionally capping the upside to protect their short gamma exposure, turning what looks like a straightforward retail bull run into a highly sophisticated institutional chess match. When you look at recent stock movement, the daily swings tell a fascinating story of institutional accumulation battling retail exhaustion. Volumes have spiked significantly over the last few sessions, showing that heavy volume is no longer effortlessly driving the stock to new highs, but is instead acting as a battleground between opposing market forces. Sector momentum across the broader semiconductor space has shown a distinct divergence. While foreign components like the South Korean equity index surged heavily on the back of suppliers stabilizing high-bandwidth memory chips, the domestic pricing structure has faced a great deal of friction. Macroeconomic pressures, particularly sticky inflation metrics and rising bond yields, have forced asset managers to reconsider their risk-adjusted capital allocations. This macro drag means that even when the underlying operational performance delivers a massive blowout report, the macro environment acts as a heavy anchor, preventing immediate valuation expansion. It is exactly the kind of friction that changes how professionals view asset classes, shifting capital away from pure momentum plays towards highly strategic, multi-layered risk management models. This institutional push and pull is exactly why so many retail investors get caught on the wrong side of sudden daily swings. They log into their individual brokerage accounts or check their mobile apps, expecting a simple green day, only to realize that large market makers have already priced in the entire move weeks in advance using complex derivatives. If you want to build wealth over the long term, relying on a basic setup is rarely enough to navigate these macro shifts. Many modern traders are turning to specialized platforms to optimize their capital allocation strategies. For instance, exploring structured options through specialized frameworks like Schwab Intelligent Portfolios or utilizing dedicated tools on an online investment platform can provide structural advantages. Whether you prefer a completely hands-off approach through an intelligent portfolio or you lean heavily into self-investing, choosing the right digital environment is critical. The market is full of competitive options, from established institutional names like Fidelity Investments to nimble retail-centric spaces like the Robinhood trading platform. Each ecosystem offers vastly different execution speeds, order routing mechanisms, and access to complex financial products that can help protect your portfolio when single-name volatility starts to spike unpredictably. To truly understand how this dynamic plays out in real time, we have to look closely at the underlying mechanics of how these different platforms execute retail orders. When an individual places a trade on an online investing site, that order is frequently routed through wholesale market makers who internalize the volume, using retail sentiment as a counterweight to institutional hedging. If you are managing your capital through a Fidelity brokerage account or utilizing specialized Fidelity mutual funds and Fidelity ETFs, you are operating within a deep institutional architecture built to absorb broad market shifts. On the flip side, using a retail-centric platform like Robinhood Cash Management or executing smaller trades via Robinhood fractional shares means you are often riding the absolute crest of retail sentiment waves. When retail call option buying reaches a fever pitch, it forces market makers into a short gamma position where they must aggressively buy the underlying stock to remain delta neutral. This mechanical loop often explains those massive unexplained intraday surges that happen completely independent of any actual news. This structural fragmentation is exactly why professional wealth management teams look at a stock through a completely different lens than the average retail trader. While a retail investor might look at their app and see a basic price chart, a professional managing portfolios within Fidelity Wealth Management or configuring specialized asset allocations across various Fidelity IRAs is focused entirely on systemic liquidity and risk premium. They track how institutional capital flows across major ecosystems, balancing exposure between legacy equity tranches and modern digital brokerage options. For traders who want a hybrid experience, blending high-yield cash features with active market access, platforms like SoFi Invest have grown significantly. The rise of SoFi investing, along with specialized SoFi ETFs and the automated SoFi robo-advisor system, shows just how much the digital landscape has shifted towards accessible wealth building. Yet regardless of whether you choose SoFi active investing or stick to an institutional giant, the underlying asset behaves according to cold, hard liquidity constraints that care very little about which application you use to buy the shares. For the most sophisticated market participants, execution speed and deep international market access become the ultimate differentiators. This is where high-powered, low-fee institutional ecosystems come into play, offering deep structural benefits for those who know how to deploy them. Utilizing an interactive brokers trading setup or navigating the comprehensive interactive brokers platform gives advanced traders a direct window into dark pools and complex order books that are hidden from casual view. Understanding the specific interactive brokers fees and maintaining a dedicated interactive brokers account allows serious investors to run advanced option strategies, like short volatility spreads, directly against the massive retail waves flowing through simpler apps. When you can see the actual order routing and track the institutional footprints across a professional stock trading ecosystem, you quickly realize that the daily price action is rarely dictated by public news headlines, but is instead driven by systemic structural rebalancing. Comment below how many shares of NVIDIA stock you currently hold in your portfolio right now. It is always fascinating to see the distribution of ownership across different platforms and to track whether the community is actively accumulating or trimming exposure at these specific price levels. To fully grasp why this enterprise commands such a massive premium, we have to step back and analyze what the core business model actually looks like behind the market ticker. The company functions primarily as a fabless architectural designer of high-performance graphics processing units and specialized computational systems. Instead of spending billions of dollars operating physical silicon manufacturing plants, they focus entirely on intellectual property, microarchitecture design, and software stack integration. They license and outsource the actual physical fabrication of their microchips to advanced global foundries, allowing them to maintain exceptionally high gross margins that regularly hover above 70%. Their revenue engine is divided into several key segments, with the data center division acting as the primary growth driver, supplemented by their legacy gaming hardware business, professional visualization architecture, and emerging automotive computing platforms. This architectural focus allows them to scale operational capacity rapidly without getting bogged down by the massive capital expenditures associated with heavy industrial manufacturing. Historically, this business model was almost entirely dependent on the cyclical consumer gaming market. For decades, their primary financial reports lived and died by the seasonal demand for high-end desktop video cards and home entertainment consoles. Older financial reports from prior cycles reveal a business that was deeply tied to PC upgrade cycles and cryptocurrency mining booms, which created massive revenue spikes followed by sharp inventory corrections. However, over the past several years, the management team executed a massive strategic shift, intentionally migrating their core focus away from consumer entertainment towards enterprise-level accelerated computing. By building a proprietary software ecosystem alongside their hardware, they locked in enterprise clients who found it incredibly difficult to migrate to alternative hardware platforms without completely rewriting their underlying operational software code. This structural moat completely transformed the financial profile of the enterprise, turning a cyclical hardware vendor into a highly predictable infrastructure-level juggernaut. Looking ahead at the future outlook, the strategic trajectory of this asset will be defined by a clear set of catalysts and structural risks. The primary upside catalyst rests entirely on the projected capital expenditure plans of global technology infrastructure providers. Large hyperscalers have indicated a massive commitment to scaling physical data center infrastructure over the next several years, with industry estimates suggesting that total infrastructure spending could top $1 trillion in the near future. If these massive capital allocations materialize as projected, the demand for advanced computational architecture will remain structurally supported, allowing the enterprise to maintain its dominant market pricing power. Furthermore, the expansion of sovereign data infrastructure, where individual nations build out localized computing networks independent of global corporate clouds, represents a completely new, unexploited revenue stream that could sustain growth even if domestic corporate spending begins to cool down. Conversely, the downside risks are deeply tied to supply chain vulnerabilities and the inevitable arrival of direct technological competition. Because the enterprise relies entirely on a highly concentrated network of global silicon foundries for its physical production, any geopolitical friction or manufacturing disruption could instantly halt product delivery and severely impact revenue generation. Additionally, major cloud service providers are actively developing their own in-house custom application-specific integrators to reduce their long-term dependence on expensive third-party hardware. If these proprietary internal designs begin to match the performance efficiency of standard commercial chips, it could introduce significant margin compression and force a severe downward re-rating of the stock. Weighing these potential future hits requires looking past the immediate retail excitement and focusing entirely on the long-term sustainability of their structural software mode. When we synthesize this entire landscape, the stark contrast between market expectation and structural reality becomes undeniable. The prevailing retail expectation is that the enterprise possesses an impermanent monopoly that will effortlessly expand its valuation without facing structural limits or market friction. The reality, however, is a highly complex mechanical ecosystem where institutional distribution, changing derivative structures, and emerging infrastructural competition are actively working to reshape the risk-reward profile of the equity. The current intraday consolidation is not a sign of operational weakness, but rather a structural pause as the broader financial system absorbs a massive volatility crush and realigns capital across competing platforms. By maintaining a sober analytical perspective and tracking the institutional mechanics rather than the public retail sentiment, investors can navigate these volatile waves with true clarity and structural authority.
This video is for educational purposes only, not financial advice. Please do your own research before investing. Market involves risk. Like this video, comment your thoughts, share with your friends, subscribe for more updates,